In the face of what appears to be a lot of volatility, some of the numbers coming due this week have the potential to trigger even more market volatility. Let's take a look. Before we begin, remember to like this video and subscribe for more economic updates. Last Thursday, the Institute for Supply Management revealed that its Manufacturing Purchasing Managers Index for July tumbled to 46.8, the lowest level in 8 months. The measure was a disappointing surprise for markets, which fell sharply on the news over revived recession fears. This week, ISM will release its July Purchasing Managers Index for the services sector. And while the news is expected to be a little brighter this time around, you can be sure financial markets again will have something to say if there's another downside surprise. Economists are expecting services PMI to come in at a measure of 51. That would be an improvement over the 48.8 reading in June, which was just the second time in the last year and a half the services number had landed below 50, which is a sign of contraction in the sector. Notably, the index is currently at its lowest level in more than 4 years. This raises the possibility that a surprise to the downside could be interpreted by markets as another sign of looming recession. Last Thursday, first-time unemployment claims for the week ending July 27th came in around 249,000, which is close to a one-year high. Then the following day, the Labor Department revealed the unemployment rate for July climbed to 4.3%, the highest level in more than 2.5 years. It is against this backdrop that the number for initial unemployment claims filed the week ending August 3rd will be revealed this Thursday. Economists are projecting claims to come in at 245,000, slightly fewer than the previous number, but still suggestive of a slowdown that's continuing to build in the labor market. For perspective, claims averaged 211,000 per week during the first 4 months of this year. Over the previous 3 months, however, the average has climbed to 233,000 per week. Shifting gears, on Wednesday, the Federal Reserve will provide a status report on Americans' debt burdens when it releases the G19 Consumer Credit Report for June. In May, total consumer credit outstanding increased by $11.35 billion month over month, pushing the total to $5.06 trillion for the first time. It's expected that the total rose yet again in June, with economists projecting an increase by an even larger $11.5 billion. Finally, in what may prove to be another sign of a possible economic slowdown, the Commerce Department is expected to report on Tuesday that the U.S. trade deficit narrowed in June to $72.5 billion from $75.1 billion in May. The figure for May is the largest for the trade deficit since October 2022. However, analysts have suspected the deficit might start to narrow as consumers demonstrate less willingness to buy foreign-made goods in a slowing economy and imports drop as a result. That's it for now. Considering all the volatility, you're going to want to check back with us on Saturday to see what actually happened. This is Devlin Steele for Augusta Precious Metals, signing out.